Had another good day today. You see, this isn't that hard. So, some days you have bad days, some days you have good days. Today, we want to talk about legging into a call vertical spread and understanding the risk profile. I have a few questions. Matt Schmidt had just raised the question in today's video on oil tankers and setting up positions for earnings coming up in the next 2 weeks. And his question was trying to understand what kind of risk am I taking when I sell a call against a call I own. So I want to walk you through this real quick. If you look at my portfolio down here, I bought a 65 call for $1. And then when the stock rallied, I sold a 75 call for $1.80. So he's asking, what is my risk? Over here you can see the stock. You can see it dropped down below 60 last Thursday, and right near the low I bought a call, and then when the stock went right up here near the high of the day, I sold a 75 call. So now what we're going to do is we're going to go to the Analyze tab to understand the risk profile. It's really important that you learn how to use this tool if you're using Thinkorswim, because it helps you to visualize what could happen to your position. Now be very careful with using the purple line to understand what your position will do between now and expiry. I'm not going to go into the details around this today, but there's some scary things that can happen around this that I've had to deal with. So be very careful when you watch this purple line, which is telling you what your position P&L is on the day. Because if you start to move this forward, what the problem with this is that you need to understand how implied volatility skew changes when you're doing spreads. So we own a 65 call and we're short a 75 call. The vols can change, but not consistently between the strikes. In other words, your long strike, your vols might go down, and your further out strike, your vols might go way, way up. This may significantly change your risk profile. Okay, so just focus on the blue line, which is just telling you what's going to happen at expiry. Stay small enough so that no matter what happens between now and expiry, you're not getting margin calls. Stay small. Then you don't have to worry about some unusual events or pressures being put on the stock. Okay, so I'm just going to leave it at that. It's a little more complex, but if I can just get everyone to stay small, then we don't need to spend a lot of time trying to understand those unusual events that rarely happen, but when they do, you need to deal with it. But you only have to deal with it if you're big. If you're small, you don't deal with it. So that's why I keep emphasizing stay small and things will work out at expiry, and no one can force you to get out of your position. So we bought the 65 at $1. We sold the 75 at $1.80. They all expire this Friday, and we have earnings tomorrow. What is my risk? Well, let's go out a little bit further, and you can see what's my risk. Here's your profit on the left side. Okay, if we go above 75, my max profit is right here. This flat line means I don't make any more money, and that number is there in the bottom left-hand corner right here. You see this number? So when I go to the right, 1,080 does not change. So the most, that's all I can make is 1,080. And then if the stock goes below 75, which is at the bottom, you see as the stock goes down, my profit goes down. And at 65, that's it. My profit never gets lower. And what amount is that? $80. Okay? The most I can lose is not lose $80. The most I can lose is I can make $80. So I can make 80% return guaranteed. 80% return guaranteed for a week. But I'm looking for 1,000% return. And where's the stock right now? It's right in the middle of those two strikes. So I have an equal chance of it either going down to a profit of 1 time or a profit of 10 times. So of course I'm going to stay in this position. Why? Because markets are random. They could go either way, $5. One way I make 1-time return. The other way I make 10 times return. And if it stays right in the middle, I make 5 times return.